So in this video, we're going to go over exercise problem number 4 in chapter 6. So let's read the question first. Ju boards sells a snowboard. Uh, the name of the snowboard is Expert. That is popular with snowboard enthusiasts. Information relating to Ju's purchases of Expert snowboards during September is shown on the next page. During the same month, 121 Expert snowboards were sold. Juice uses a periodic inventory system. So some of the important information we can find here is that 121 snowboards were sold and they use periodic inventory system. So in the next page we can see that the beginning inventory amount here, this is the beginning inventory, and these three are the purchases, right? So total is, this should be what? Total units available for sale, and this amount should be cost of goods available for sale. Okay, yes. And then let's go to question instructions, and it says compute the ending inventory as September 30th and cost of goods sold using FIFO and average cost method. Prove the amount allocated to cost of goods sold under each method. Okay, so we have to do what? Find the cost of goods sold and ending inventory amount. All right. But before, it says here in the question, they sold 121 sold, right? Okay, so there are two costing inventory costing method, here perpetual and periodic. One is perpetual and the other is periodic, and both have FIFO and average cost. So we know that the FIFO under periodic and perpetual are same. Okay, they are same, but average cost is not same. Okay, so under perpetual method we call this average cost moving average cost method, and this is simply taking the average of all the cost of goods available for sale over total unit available for sale. This is simply find the ratio, the cost ratio, by doing this. Total units available for sale. Okay, so if the question asks you to do perpetual and periodic, if it asks you to do FIFO, they are just basically the same thing, so you should not worry much. But if it asks you to do average cost and under periodic and perpetual, they're different. So this moving average cost ratio, it changes whenever purchases are made. So the average changes when there is a purchase. Okay. Here it says use periodic inventory system. So we are going to do this one, periodic, and we know we're going to do FIFO and average cost. Okay, let's do the FIFO first. So we know there are some information here, 121 units sold, and we know that total units available for sale is 132. So in the year end or the month end, 132 minus 121 should equal 11, right? This amount is in the inventory. Ending inventory unit. Okay. So this 11, because we are using first in first out method, we are going to eliminate inventory in time basis. So the beginning inventory will be used first. So these are out, and these are all sold. And the ending inventory will cost at $1,050. So that means 11 units. The remaining 11 units will cost at $1,050. So the ending inventory amount should be 11 times $1,050, which is 11550. Okay. All right, then let's find COGS. Okay, let's find COGS. How do we calculate COGS? How to calculate COGS? We know that COGA minus the ending inventory is COGS. And we have this COGA here, which is $135,000 and $135,210. Okay, this is one. And now we deduct the ending inventory amount we calculated just before, and this will give you $123,000 and $123,660. Okay, so there you go, your COGS here, your ending inventory here. Yeah, see here, we know the units remaining in inventory, and then we calculate it by using FIFO because it will be used first in first out. So the beginning amount will be used first, and the next purchase will be used then the next purchase will be used. So remaining 11 units will cost at $1,000.50. $1,050. Okay, that is FIFO. let's go and use an average cost method. So what we're going to do, we're going to calculate the average of the entire cost of goods available for sale over the units available for sale. So if we do this, we take the number and divide it by how many? 132. Here, 132. $132. So this will give us the ratio approximately $1,024.32. Okay, and we're going to use this ratio to find the ending inventory. Okay, we know that there are 11 units remaining in the inventory, and we simply multiply the ratio we just calculated with the unit, and it will give us the ending inventory, which is what, $11,000 and $268. $11,268. $11,268. Okay. Next, we are going to find the cost of goods sold. We just use the same method over again. We have the COGA, which was $135,210 less ending inventory, which is $11,268. So if you do that, we get the cost of goods sold, which is $123,942. Okay, and you see here the unit cost is increasing over time, right? In the beginning, the cost was $970. The next purchase was made at $1,020. The next at $1,040, and the last purchase were made at $1,050. So the cost is increasing. That means it is an inflation. Okay, this is an inflation period. All right, then we can compare the ending inventory of FIFO and average method. Which is bigger? Ending inventory amount using FIFO was $11,550, but ending inventory using average method was $11,268, which is bigger. Oh, we see that FIFO is bigger, right? 11,268, 11,550. This is bigger, right? So we can say that under inflation, using FIFO has bigger ending inventory over using average cost method. Okay. And what about cost of goods sold? Since the ending inventory is higher for FIFO, the cost of goods sold will be smaller for FIFO and bigger for average. Okay, let's compare the cost of goods sold then. COGS for FIFO is 123,660. 123,660. But using average, you can see is 123,942. See, the average is bigger. Average cost method has bigger COGS under inflation. This effect will be vice versa when it's deflation. Okay, so you should know how these affect net income and retained earning and your tax and so forth. That's basically it for this exercise problem. And